Happy Monday, everybody. Welcome to another episode and a new week of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We have a big episode today. This episode also contains this month's first sponsored feature. As regular viewers will know, sponsored features are limited to just 1 to 2 long-form features per month. I am especially excited about this sponsored feature. Of all the companies that I work with, this is the company I am most bullish on, so I'm very excited to introduce you once again to this wonderful company. We'll touch on that later in the episode, but first up, let's begin with the Chinese economy and jump in. Few commodities capture the arc of China's 21st century growth story as vividly as cement. Once the backbone of the country's urbanization drive, its slow collapse in use is a powerful symbol of China's construction and, by extension, economic decline after decades of breakneck expansion. Cement production posted its weakest July since 2009, the global financial crisis, according to official data released over the weekend. Output fell more than 5% from a year earlier to about 146 million tons, weighed down by an unresolved property crisis, which we know is now almost half a decade old, and sluggish infrastructure activity. Extreme weather, including heat waves and heavy storms, further dampened construction. Unlike steel, much of which feeds export industries, cement is a uniquely domestic barometer of demand. Skyscrapers, high-speed rail lines, and sprawling housing projects fueled annual gains in output from 1990 until 2014. Peak cement arrived in May 2020, when Beijing's pandemic stimulus briefly revived construction. Since then, the downturn in real estate has steadily eroded demand. The broader economic picture is equally troubling. From Beijing's perspective at least, industrial activity, investment and retail sales all slowed sharply in July. Steel output marked its weakest July since 2017. Property investment contracted at its steepest pace since 2020, and yuan-denominated loans shrank for the first time in 2 decades. For cement producers, the challenges extend beyond demand. The sector remains subject to Beijing's supply-side reforms, which aim to curb overcapacity and reduce emissions. Analysts expect further declines as plants are required to trim output to align with weaker consumption. The slump signals more than a cyclical downturn. It highlights the waning of an era when construction served as the bedrock of China's economic miracle. With households cautious on spending and the property sector under prolonged strain, the old engines of growth are faltering, and cement, once a symbol of abundance, now epitomizes that slowdown. Next up, US President Donald Trump said over the weekend that he will hold off on raising tariffs on Chinese goods tied to Beijing's purchase of Russian oil, citing progress in his talks with Russian President Vladimir Putin on ending the war in Ukraine. Quote, "Because of what happened today, I think I don't have to think about that," end quote, Trump told US-based Fox News after the Alaska summit with Putin, adding, quote, "Now I may have to think about it in 2 weeks or 3 weeks or something, but we don't have to think about it right now." End quote. Earlier this month, Trump threatened to penalize countries that continue buying Russian energy, aiming to increase pressure on Moscow. India has already been targeted with tariffs on its products doubling to 50% starting the 27th of August. Extending such measures to China, however, would jeopardize a fragile trade truce. Just days ago, Washington and Beijing agreed to extend their tariff ceasefire to 90 days, easing duties that had reached record highs in the spring and unsettled global markets. China has defended its purchases of Russian oil as both legal and essential for its energy security. Trump acknowledged that a ceasefire deal with Putin was not reached, but said the leaders agreed on, quote, many points, end quote. He also urged Ukrainian President Zelensky to strike a deal with Moscow. Quote, "I think, the meeting went very well," end quote, the US president said, leaving open the possibility of future economic pressure if diplomacy fails. One of the most interesting and controversial developments in finance in recent years has been the rise of digital assets, especially now that the US administration is embracing crypto. Many traditional investors are increasingly interested in having some exposure to digital assets in the higher risk, high return part of their portfolio. However, they want to do so through holding traditional stock assets rather than dealing with holding digital assets themselves. There is also demand for a diversified holding of these assets. Today's video sponsor, DeFi Technologies, Technologies, listed on the Nasdaq as DEFT, provides an attractive way for investors to do just that. DeFi Technologies is a financial technology company that allows traditional investors to gain exposure to a diversified portfolio of digital assets across the decentralized finance and Web3 sector. I have worked with DeFi Technologies as a sponsor for well over a year now. Indeed, since my first featuring of DeFi Technologies in June of last year, the stock for their company has surged over 150% and graduated to the Nasdaq. I have and continue to be super bullish on this company. Indeed, the stock has outperformed even Bitcoin for years. Look here, 1 year performance, Bitcoin 76%, DeFi 122%. 2 year performance, Bitcoin 238%, DeFi 3,474%. How has DeFi Technologies been able to achieve this? DeFi Tech is a portable business that grows globally with the continuous adoption of decentralized finance and crypto assets. The crown jewel business is the company's subsidiary Valor, which creates and issues ETPs, exchange traded products, for the cryptocurrency sector. As this image shows, at the end of May 2025, Valor had $800 million under management. Valor offers over 75 exchange traded products, ETPs, covering the full spectrum of the crypto market. This is the model that makes it so profitable. The ability to provide institutions who are barred from their forming documents from owning cryptocurrencies outright, but are 100% eligible to own ETPs. Even after reporting record revenues this past quarter, and even after surging more than 250% in the past year, the company still trades at a trailing price-to-earnings ratio of under 10. Another department that is under Valor engages in staking and lending, and this helps to generate approximately 8% on AUM that is stacked or loaned. The Trump administration has taken significant steps to reshape US cryptocurrency policy, and DeFi Technologies management has taken notice and made an acquisition recently that gives it US exposure, while it continues on its global expansion plans, as you can see here. As Valor's parent company, DeFi Technologies is the largest institutional asset manager of Solana in North America. DeFi Technologies earns an 8.5% yield on stacked Solana, generating up to $33 million in annualized revenue based on current asset prices, more than any other asset manager or public Solana holder globally. DeFi Alpha is another business department that has been a resounding success for the company. The trading desk has generated about $100 million in the first year, and these funds are retained in the company's balance sheet. Since the company graduated to the Nasdaq, several analysts have begun covering, along with those that issued reports on the company in the months leading up to that moment. You can request that they send these reports to you. By emailing the analysts, you can see how they think about all things DeFi tech. What's more, DeFi Technologies is one of only 3 profitable public crypto companies. They just had a record quarter, and their projected revenue for 2025 is over $200 million. Founder of DeFi Tech, Olivia Newton, owns 17.9 million shares, which are worth over $50 million. Newton has been in this industry since 2010, making him one of the most experienced crypto entrepreneurs on the planet today. So you have a company with a solid foundation, with a low price-to-earnings ratio, an explosive industry, a friendly administration, and an experienced leadership putting their money where their mouth is. This sort of move is a speculative opportunity. Higher risk, but also high reward. DeFi is a company worth looking into and doing your due diligence on. This is a sponsored feature. It is not individual investment advice. Relevant disclosures, including more information on this company, are in the description below. Thank you so much once again to DeFi Technologies for sponsoring this episode of China Update. We now return to regular China Update coverage. China's central leadership has repeatedly pledged to move away from debt-fueled building sprees toward what it calls high-quality growth. But a new report by Yu Hanzhang of Carnegie China, the Chinese investment Riddle, What Cities Reveal, finds that on the ground, many local governments remain stuck in old habits, pushing heavy investment to keep growth afloat, even as its productivity payoffs diminish. The study of 40 cities showed stark contrasts in development models. Third and fourth tier cities, the poorer, more populous parts of the country, recorded investment intensities averaging 58% of GDP in 2020. 2024, far above the national average of 40%. With real estate revenues collapsing, local officials have leaned heavily on industrial and infrastructure projects to fill fiscal gaps. Second-tier cities sit closer to the national average, reflecting some moderation, yet they remain caught between outdated reliance on capital spending and an incomplete shift towards innovation and consumption. By contrast, China's top-tier hubs, Beijing, Shanghai, Shenzhen and Guangzhou, along with advanced second-tier centers such as Nanjing and Hangzhou, are charting a different path, showing much lower investment to GDP ratios as their economies become more service-driven. More investment has not meant greater efficiency, however. Zhang's analysis reveals a negative correlation between investment intensity and productivity, negative 0.21 with labor productivity and 0.62 with total factor productivity. In some places, overlapping industrial strategies are producing underutilized capacity and cutthroat price competition, undermining efforts to foster genuine innovation. The consequences extend to household spending. In non-Tier 1 cities, investment intensity is strongly negatively correlated with consumption, negative 0.7. Big-ticket projects crowd out consumer demand, while falling property prices further sap household confidence, leaving retail sales subdued. Tier 1 cities offer a different picture. While labor productivity looks lower due to the dominance of public and service sector employment, these hubs outperform on total factor productivity. For multinational firms, Zhang stresses these diverging city trajectories matter. Tier 1 cities remain natural destinations for research and development, premium consumer offerings, and regulatory engagement, thanks to their institutional quality and international integration. Select Tier 2 cities, including Wuhan, Hangzhou, Nanjing, and Jinan, are emerging as attractive alternatives, pairing expanding consumer bases with improved efficiency. Lower tier cities, which represent the majority of the population, meanwhile, remain riskier bets. Though some target clean tech and renewables, overcapacity and weak consumption make them challenging markets that require selective engagement. Ultimately, Zhang concludes China's national agenda is clear: pivot from brute capital accumulation toward innovation, productivity, and stronger household demand. But whether that vision is realized will depend on how local governments allocate resources. And at the moment, this allocation is not being done well. Market-oriented credit systems, stronger legal and regulatory frameworks, and policies that boost household incomes and social safety nets will be key to ensuring that innovation delivers sustainable growth, he argues. But for many of these locations facing so many systemic issues, for much of the country, this structural collapse cannot be reversed. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for another episode tomorrow.